Mark my words, guys, you guys are going to be hearing about this a lot more in the news as the months go on, but you already heard it first because we've been paying attention to what's been happening globally and what's been happening in China. And so we already know that the exports were about to start collapsing. Now, the question I have is how long does it take until the Chinese regulators revise their GDP growth estimates to a negative level? And I do believe that we're going to see that in 2023. And so let's get into that. You're watching More Money. Let's get it. What's up, guys, and welcome back to the channel. And this is not any new news for anybody that's been following this channel. However, now we're starting to see the evidence of exports starting to decline in China as a result of lower economic demand from Western countries. And you guys would remember that when I talked about sort of like the themes for 2023, this was one of the major risks that I identified for China. And a lot of you guys, like, I'm not telling you guys anything that you don't already know. The beauty of this channel is that we got some of the smartest investors and viewers who watch this channel, which is totally humbling because you guys always correct me whenever I miss anything, and so it allows me to get smarter as well. But you guys already know that we were expecting this, and you guys were making that comment in the comments below that, yeah, you're bulls on Alibaba and Tencent or whatever, but you guys are also watching this economic situation that's transpiring, and so now we're seeing it. And so what am I talking about? Well, you can see it right here. China's export declines deepens, threatening growth in the country, and so the cooling global demand is complicating China's rebound. And you guys already know this is not new news to us because we've been calling out the fact that if there's going to be a slowing Western world, it could absolutely threaten the growth and recovery of China. And look, these guys are targeting a 6% GDP growth, 5 or 6%, somewhere in there in 2023. And you guys already saw what happened when they forecasted out growth in 2022, but they stuck to their lockdowns and, you know, growth didn't hit that 5% target. Well, now they're out of lockdowns, and in fact, they got out of lockdowns very quickly, might I add. But now you have another headwind, which is the global economic slowdown. And so how do you expect China to achieve 6% growth? Now, in my Alibaba model, I gave Alibaba 7.5% growth for 2023, but I think that just effectively just gets offset with, you know, lower growth in 2023 will get offset by higher growth in subsequent years as sort of like a catch-up. But we'll see how that plays out. But of course, we take a huge margin of safety on Alibaba anyway, so it doesn't matter if growth is 7%, 7.5%, or 3.5%. We're still going to be buying the company for significantly under what we determine its intrinsic value is, because short-term impacts don't necessarily significantly impact the long-term valuation of any security, and that's generally how I like to invest. And so let's dive into the article a little bit. So you can see that the declines in exports are actually picking up, the rate at which. So the decline for Chinese exports got steeper in the final month of 2022, falling 10% from a year earlier compared to an 8.7% drop in November. So, you know, this is not looking good. And, you know, the economists actually expected a 10.5% drop. So this is good news relative to what they were forecasting. However, this is bad news from my perspective because exports are dropping 10% year over year, and we're not even in a recession right now. What does a recessionary export year over year decline look like? Are we down 20%? Are we down 30%? Like, I might just be overstating it, but you know what I mean? Like, we're not even there yet. And they've already had a horrible December. And so, you know, this marked the biggest dip since February of 2020 when a nationwide lockdown brought economic activity to a halt. So in other words, what the newspaper just said is that the last time China had that much of a dip in its monthly exports is when the whole world was locked down. Does that not scare you? And truthfully, I'm not going to lie, it doesn't really scare me. Not much really does. I'm a beaten up and battered Alibaba investor. So this is just another thing that we got to deal with. And at the end of the day, you know, this is why I always preach about diversification and focusing on proper investment strategy. So at the end of the day, this really doesn't matter, but I still think Alibaba outperforms over the long term. Now, that might just be wishful thinking, but I see a lot of evidence to support that. Now, let's go back just a year ago. So this article was published in January 14 of 2022. What this article showed is that China's export machine notched a new record as the pandemic went on. And so, you know, effectively what happened here is that China's lockdowns, or the economic impacts of their lockdowns, were offset by the strong amount of exports that were still coming out of China in that environment. And you guys already know that that's the time at which a lot of Western companies ended up having inventory gluts and that sort of stuff. And so now, I wrote it here. This article is just from 1 year ago, but it showed that the export boom that helped China weather the pain of the pandemic is now nearing its end. The current acceleration in declines have reinforced concerns that China will no longer be able to count on robust trade to propel its growth in 2023. And the reason for that, of course, is because the world is slowing. Inflation is running hot. Just because inflation has been coming down as of late doesn't necessarily mean that, central banks are not going to keep rates high to put the brakes on the economies. We're seeing that happen all over the world. And just going back into the initial article, export growth held up more strongly than expected until October, but central banks' campaigns of interest rate increases to tame inflation has hurt demand for Chinese goods. And this is exactly what we were predicting that was going to happen. So it's just happening now. That's all it is. And so Beijing's sudden abandonment in November and December of its zero COVID policies, of course, led to a near-term shortage of workers as people got sick, et cetera, et cetera. But, that's just near-term. These people will be back. However, the bigger problem, once again, is how Western consumers' appetite for made-in-China goods like computers and bicycles will hold up, especially in an environment where we have a glut of a lot of inventory. So these, retailers, they still have a lot to get through before they're going to be putting more buy orders into China. And it's not like there's supply chain issues or the same level of supply chain issues. So it's not like they're going to overbuy in this coming environment. At least I don't think so. The other thing is cash management and inventory management are going to be very tight in this environment. And so another reason why there's probably just going to be fewer exports out of China. And so things are going to slow down, at least in my opinion. But I'm just one person. Overall, what do the sort of authorities of the world think about global growth in 2023? Well, I got an article for you guys. So the World Bank is expecting that the global growth is going to slow. And so here's just a quote from this article that just came out, I think just a couple of days ago. The bank expects global growth to slow to 1.7% in 2023, down from an estimate of 3% growth in June. That would mark the third weakest pace of global growth in nearly 3 decades. So in other words, we are expecting the third slowest growing year for global growth in 30 years. And so, it's overshadowed only by 2009 and the 2020 downturn. And so in other words, we are expecting the equivalent of a financial crisis or a pandemic. That's what we're comparing 2023 against. That's kind of crazy. And so a separate report showed that global inflation, while starting to cool, remains historically high. So, the whole words about, what Michael Burry was saying about he's still very short on stocks and et cetera. And, you guys know, I already went back and showed you that I still think stocks are relatively expensive, which is why I haven't been buying things hand over fist. And this recent run up in the security prices, yeah, it's good. It's nice to see, unrealized gains in our portfolios. It's really nice for my portfolio. I can't remember the last time I've seen such a large unrealized gain in the portfolio. So I guess it's cool, I guess. But I also believe, at least in my heart, that we're going to be giving up a lot of these gains sometime in the near term or whatever. So I'm not going to give you guys investment advice. I never will. But, if you have the opportunity to take some profits on some stocks that are nearing their sort of intrinsic value, now might be the time. And of course, I've already shown this to you guys, but economists do expect a recession and job losses by next year. And so, the majority think that the Federal Reserve will actually start cutting rates in 2023 or early 2024. The Federal Reserve doesn't think so, but, according to a new survey, economists see a 63% chance of a recession in the next 12 months. And we don't need to read articles to see that. The best place where we kind of see what people are thinking about, and you can actually find this chart on gurufocus.com, is that we are still in an inverted yield curve environment. And that's a situation where the 10-year yield is lower than the 2-year yield. And the reason why that is because, investors expect the Federal Reserve to lower short-term rates because they only really control the short-term rates. And so the 2-year yield will actually come under the 10-year yield. and the 10-year yield is just kind of below that right now because the 2-year yield or the Federal Reserve has not started to reduce rates just yet. And so, there is and why would they want to reduce rates? Well, you guys already know that they would want to reduce rates because the economy is now starting to go into a recession, and we need to sort of help the economy by lowering the borrowing costs. And so that's why the rates would decline. That's why you're seeing an inverted yield curve in this environment. And just going back to that initial article, cooling exports leave Beijing with little choice but to try to engineer an investment boom. Okay, we'll see what happens there. And, they're trying to achieve a GDP growth of 5% or more this year. The officials are hoping, but like I said, they were hoping for this last year. They never got it, and they're not going to get it this year. I'll tell you that for sure, at least in my opinion. And so shrinking export orders threatening to ripple through China's labor market is an absolute certainty as far as I'm concerned. Heavily indebted local governments have little incentive to embark on a wave of new infrastructure projects, which is absolutely true. In fact, they can't even, or some of them, in fact, you know what? I actually made a video before where I showed you where some local governments are actually relying on debt to pay for just regular spending. So it almost seems like a Ponzi scheme. In China, the CCP, the central government, is trying to cramp down on that. But, these local governments are between a rock and a hard place because nobody's buying property. And so these local governments don't have any revenue sources. And so you have a real issue here. And then, it's not like the households, like individuals in China don't see economic pain on the horizon. And so, they've seen their incomes hit throughout the pandemic, and they are resisting to spend. You can absolutely guarantee that there's a lot of smart people who are holding on to their money. They don't have confidence in the economy. And so you could see that you're not going to get a spending move or an economic boom in China, especially as there's further job losses because exports continue to decline year over year. And so a recovery in domestic consumption likely won't make up for the loss in overseas orders. You can say that again. A senior China strategist estimated that exports could decline by 5% this year from 2022. And I'm saying that it's probably going to be more than that. But I'm notoriously pessimistic, so don't believe anything that I say. And so, unemployment pressure could become more acute amongst the country's 290 million migrant workers. And, we've already seen that. A lot of people have already gone home and they haven't come back. And so I believe that this could get very bad for China. And so we'll see how this plays out, but a weakening global economy is bad for China as a whole. And so, this is another thing that we got to pay attention to as we're investors in Chinese companies. But I think what this really does, and I'm just going to be very honest with you guys, is that if this causes the share prices for these companies to significantly decline, and I think it has the potential to do that, we might be able to catch more of Alibaba in that $70, $60 per share range, especially if exports stay lower for longer. We go into a recession in 2023 and we stay in the recession in 2024. You could have an opportunity to pick up some of these securities for very cheap, but at the same time, in that environment, you have to compare it to the other opportunities that exist in the market as well. And there might be other more interesting opportunities as well. Who knows? We might be able to get Microsoft at about half of its intrinsic value. I'm wishfully thinking there. I probably will never come down to that low, but you know what I'm saying? Just because Alibaba comes down to $70 a share doesn't mean you snap it up right away. You got to look at the environment and see what else is trading for what, and see if Alibaba is the best opportunity in that particular situation. And I know a lot of you guys did not watch that video where I sort of uncovered a quasi Ponzi scheme that I just discussed earlier in this video that's happening in China. If you missed that video, no problem. I'm going to link it right here.